Welcome, everyone. Thank you so much for being here. I am honored to be the moderator with 4 very esteemed panelists in the sector of private markets. When I was first asked to moderate this panel, the title was "Private Equity is Slowing Down." And I said, well, what if I don't believe in that title? And I'm sure that the panelists don't believe in that title. So I'm very excited today to introduce you to our 4 esteemed panelists, really subject matter experts, spent their entire careers in certain areas. So it's my honor today to introduce all 4 of you today and to make sure you come away with realizing that actually private markets may increase in these areas. So right here we have Milton Berlinski of Reverence Capital. We have Torbjorn, very strong name, of Actis, which is an infrastructure firm, Marco Brockhaus of Brockhaus Technologies, based in Germany, and Jeremy Coller of Coller Capital, the renowned secondaries firm. So I'm going to open it with this question, and I'm going to go down the line to make it a little bit easier for everybody. So Milton, you actually worked at Goldman Sachs for 26 years. Why would you leave Goldman Sachs, where you created their financial, what's referred to as the FIG group of financial services at Goldman? Why would you leave Goldman to start Reverence Capital in 2013? And what did you see as an opportunity within that sector?
So look, it's never an easy decision to leave a place you love and where you've dedicated a big amount of your life. But I always had the desire, and I'm relatively entrepreneurial. I always had the desire to help middle market companies, management teams anticipate what's around the corner based on the experiences I'd had advising, investing, and frankly helping CEOs build out their strategies. And so I finally decided it was now or never, and that triggered the desire to do this.
There's no looking back. So another proud Goldman alumni. All right, Torbjorn, I want to come to you. You recently sold a part of your firm, congratulations, to General Atlantic. For those of you that may not know, it's an incredible success story. But with everybody reading about how private credit is the new sexy asset class, what would you say to that as you're in an infrastructure firm? And for those of you who may not know, he's an incredible background. He's a mechanical engineer. He actually has built power plant stations. I guarantee you nobody in this audience has built power plants. So what are you doing? With the rise of private credit, obviously you have to build things. What are you building?
I mean, you're right. Clearly it's so that credit needs to go somewhere, and clearly we're there to build infrastructure. So I mean, Actis, we are, I would say, a leader in sustainable infrastructure. So the energy transition, digital transformation, supply chain reallocation. But importantly, we focus on where 85% of the world population lives, which is outside US and outside Europe. And where you have 85% of the world population, you have 2/3 of the investment opportunities, while only 1/3 of the capital is chasing it. 2/3 of the capital chasing the 1/3 opportunities in US and Europe. So, we are clearly investing in building things, across the rest of the world, or I would call it most of the world, because 85% of the population lives there.
I'll come back to you. I want to hear more about what you're building, as do others, I'm sure. Marco flew in from Germany today, and you have an interesting story that's also a new phenomenon relatively within the private markets, which is you were a GP, I'm a GP myself, and you decided you didn't want to be a GP anymore. You said, I'm going to be a holding company, and I'm going to be a public company. Why would you want to be a public company? Is there more scrutiny? What are the advantages to all of a sudden being not a fund manager, but a public holding company, and specifically in your area of technology investing?
Yeah, maybe to start off with, 25 years in private equity now. I started in 2000, my first fund, and then 2 follow-on funds. And instead of raising a 4th fund, I decided to move from a typical asset manager, fund manager type of style to a holding company. And we founded 7 years ago, Brockhaus Technologies, brought it public in 2020. Why? Because we want to have more flexibility. It's a typical game in private equity, as you know. You sell your stars, you get a quick multiple, but you have the dogs in your portfolio. And I believe I wanted to get out of this cycle. Instead of raising a new fund every time and now and then, I decided to invest out of the balance sheet. And that's what we almost achieved now, to be cash compounding. And got the cash flows from the daughter companies into the holding and fuel new add-on acquisitions or segment platform acquisitions. That's basically it.
Congratulations. So you mean when they say fundraising numbers are down, maybe we should all become public holding companies. Nice to know. All right, Jeremy, over to you. I've had the pleasure of knowing Jeremy for a long time. For those of you who don't know, he's not just an innovator in secondaries, and we may refer to Milton as the godfather of FIG, but he's truly the godfather of secondaries. It's incredible what you've done. Could you maybe tell people, for what I always thought, you wanted to be a primary fund, and now everybody wants to invest in secondaries. So explain to people what you saw decades ago when most people didn't even know what the word secondaries meant.
Just comparing it to public equity, when the New York Stock Exchange started in 1792, it was all about IPOs, M&A, and placings. Today, if you say you're in the stock market in the US, you're talking about buying Walmart and Apple, secondaries. Private equity became an asset class only in 1993, 30 years ago. And you'll know when the secondary markets mature because we'll be called private equity. And so, why buy in year one when you can buy in year 5 at a discount? It's the same as when Saudi played Argentina in 2022 at the World Cup. You wouldn't have given Saudi any chance before the game. But after Saudi scored 2 goals, there's at least a 70% chance that Saudi's going to win and everyone's going to have a national holiday and the players are going to get their phantom Rolls Royces. So it's a no-brainer.
Jeremy, I know you've always joked to people you would like to have more time to work on FAIR, but I think actually you're getting busier now. Everybody wants a meeting with Coller Capital and secondary. So it's incredible what has actually happened in this industry. So Milton, I want to come back to you with that. One of the advantages of being in financial services, and that is not fintech, but financial services, you really get to see what's going on in the M&A landscape. You're also working with a lot of people who need money to be able to do deals. So what are you seeing within your portfolio today for those that are listening that may be able to give some people insights into what is coming?
So look, that's a very broad question, but it's all sector specific, right? So we basically invest across 5 major sectors, one being what we call depositories and finance. Think of that as bank and non-bank finance, asset and wealth management, insurance brokerage and insurance services, fintech payments is one other sector, and then capital markets. And basically, every sector has got different needs, right? So the payment sector obviously is a scale business, and so you need real scale, and therefore the technology investments and the markets that you're going to pursue are critical. Wealth management and asset management are also scale businesses. They generate a lot of cash, and so it could be self-funding for both organic and inorganic. But we tend to try to complement the inorganic with the organic, and that requires incremental capital, particularly if you want to build a scale player, which in the RIA space, for example, you want to be 100 to 150 billion. But it makes me remember a paper I put out in 1995 for the asset management industry, where I predicted that there'd be 5 players at 150 billion, and then a lot of niche players. I got the concept right, but I got the numbers wrong, right? So today you've got managers with trillions of dollars, and they're considered the scale players, but it's also 2024 and no longer 1995. Having said that, I think we'll see more scale requirements in the asset and wealth management businesses. I think in the depository side, because of the regulatory requirements and the technology spend, and then the cybersecurity, again, heavy users of capital. So again, I think it's sector specific. And then what we're seeing is that, look, we're specialists, so we spend our time evaluating what we think are the long-term trends in a sector and how we think we're differentiated, and then investing in those sectors. And we do it by trying to do one-off transactions. So we've done 26 transactions, 21 have been one-on-one, and the other 5 have been one of 2 or one of 3. And that allows us to be differentiated, but also to get complexity out of the way. We like complexity. We like buying non-core or subsidiaries of larger banks, insurance companies that are typically undermanaged,
where we can either work with the management team, enhance the management team, or replace the management team.
Yeah, you touched on something that applies to all of you, which is that you're a sector specialist. So, Torbjorn, I would ask you this question. As a sector specialist, with the rise of AI today, would you put your money in AI, or would you put your money in the infrastructure fund that is actually going to power the rise of AI?
A very easy question. Of course, in the infrastructure, it's going to power the AI. And if you're looking at that, the need of that, I mean, clearly we are one of the leaders to build electric infrastructure in most of the world, meaning non-US, non-Europe. But if you're looking at that growth there, it's massive just because it's a multiplier of GDP. So the next 20 years, we need to build another planet of power plants, another planet. And electricity, the electricity system, is humankind's largest investment ever. And now we're going to build another one over the next 20 years. And that is, of course, a massive opportunity in itself. And on top of that, you're then looking at electrification and data centers. The whole AI and the drive there. I mean, we are investing a lot in data centers as well. We're building the data centers. But they need to be driven by green, clean energy. So there is a clear overlap here between us as a leader in the energy space, but also in the digital space. And AI is clearly a massive driver of new data capacity, new need for data centers, all needing green, renewable energy.
You can't build those data centers fast enough, I bet.
That's right.
Marco, I want to come to you within technology. It's fascinating that you are in Germany, predominantly focused within Germany, now looking into other parts of Europe. But within your portfolio, what have been the surprises, even with some of the recent geopolitical turmoil, that your portfolio is outperforming in technology? And these are, again, not companies, it sounds like, that are venture or high valuation, but what is sort of the more unsexy parts that you're finding that people may not realize, sort of everyday technologies that are actually be using, and that tends to be where you're focusing, in sort of in the non-crowded, lower valuation, lower middle market area. Can you talk a little bit more about that?
Yeah, sure. Our strategy is, I would say, pretty simple, but you just have to follow it. We have the rule of 50, means 20% top-line growth when we buy companies and 30% minimum EBIT margin. So that adds to 50. So highly profitable innovation and technology leaders, but totally agnostic and always B2B. That's it. End of story. This is our strategy. But if you go left and right, you may make mistakes. But if you center on this, it works. At least I do this for 25 years. And the last euro we lost was 12 years ago on an investment. So basically, we have currently 2 platforms. One is in high-tech data transmission in secure surroundings, such as air traffic control. So somebody who flew maybe through Dubai airports, we are in there for the signal of the plane coming up to the screen of the air traffic controller. So no latency allowed, secured, and no hacking possible, otherwise you have a problem. But on the other hand, we just saw here an interesting podium on fintech. We have also a B2B platform in our portfolio as a segment, and that's actually fintech. It's a leasing platform with over 70,000 corporate customers and 8% of the German workforce on the platform as employees, so roughly 3.5 million employees. So we are very agnostic. We had sensors to measure fine dust in air, so for all kind of pollution stuff in Europe as well as in the States and also in China. So we are really agnostic. It always have to follow the 5 topics.
Yeah, it's fascinating because everybody always thinks tech investing may be more like venture investing, but the way
it's not venture. Sorry.
Yeah, no, the way you go about it is it's impressive.
It's very similar to the Roper technology model in the US. You might know.
Jeremy, so look, you're based in London, your headquarters in London, but you seem to, you have offices all around the world, and you've been in Asia for a while. So if you're a secondaries firm today, I'm curious, is secondaries everywhere? It seems like, anytime I'm in the US, people want to talk about secondaries. But when you go to Asia, is that true? I know you were just over there. I'd love to hear, from your perspective on what that looks like more globally.
So we've just raised a renminbi secondaries fund, which is beautiful because don't you love a trade war? The Americans are selling their Chinese assets, and the Chinese are selling their US assets. So having a renminbi secondaries fund has been fantastic. And there is also another trend, if I may just add, of GP-leds. If you're General Atlantic or TCV or Carlyle, I can understand selling to a strategic or IPOing, but why would you sell to another buyout firm or growth firm? Why wouldn't you buy your favorite companies yourselves and do a GP-led? And that's a big new trend as well. And you need a secondaries fund to value it, of course.
That is correct. So you mean when managers are having trouble fundraising, they should call you?
Exactly.
All right, I want to come back to you. So, most people today, they think of technology and that's where it's going to outperform. What would you say about fintech? Do you think that fintech is going to disrupt some of the financial services assets that you have, or how do you see it?
Look, we've been spending a lot of time on fintech for the last 20 years, and I think what I would say is most fintech models haven't worked. And the reason they haven't worked is that the cost of origination versus traditional models has been much more expensive, and so that's why a lot of these companies never became profitable and never scaled. Okay, so in order for them to really displace any of the traditional means of distribution, I think they're going to have to start to get a cost structure that's more competitive. If you look at the technology itself, I think of it as fintech a lot of times as a front end, right, to a mature market generally, and they've got to take share. And so if you use that as another source of distribution, but you pay attention to the normal underwriting, I think those two worlds will live together as opposed to one will displace the other. And it's true of AI. The big hype now is that AI is going to replace asset managers, they're going to replace investors in the private equity, they're going to replace credit managers. I don't believe that. I think there will be an enhanced tool where they'll be able to help you collect the data and identify the trends faster and quicker, but you'll still need humans to play along as part of that process. But these folks will also have a different point of view, I'm sure.
So the asset managers and the banks are not going away.
No.
Torbjorn, I want to come back to you for a second. So with what's going on with interest rate and credit in some cases at the top of the stack versus the equity holders, what would you think may happen once the interest rates lower? Are people still going to be building as much infrastructure?
I mean, absolutely. And clearly, there is a need to build new infrastructure. It's a question of which capital and what type of cost it is of that capital. I think that what we've seen in infrastructure over the last, say, 20 years is, there's been a strategy to buy an asset and then ride the interest rate down while you sit and polish the asset a little bit, and then you sell it and you make money. That will not work, right, going forward. So the way to make money is to be, as we are, builders and operators. You actually construct things, you build things. There's new things coming up to be there. And that is not going to go away ever. You do need to build that infrastructure.
And do you think that, in the last few decades, people have tended to think about just private equity as mainly the predominant part of private markets? Do you think people have been underallocated to infrastructure, and now what they've seen is, wait a second, people are, allocating to private credit, private infrastructure? Do you think that will continue?
Yeah, I think it's happening. If you're looking at infrastructure, has been the best performing asset class in inflationary environment ever, right? So it's like a counter-intuitive investment from that point of view that when inflation goes up, revenue is escalated with CPI index. So your revenue goes up, but your cost base is pretty fixed because you swap those long-term interest rates to be fixed. So you make more money the more inflation you have. So there's a counter-cyclical element to it. But at the same time, clearly the need to build new infrastructure across the world is massive. It's absolutely massive. And that you can see more and more LPs allocating more and more capital into the infrastructure space.
All right, so we're long on infrastructure. Marco, I'd love for you to give an example for those people that may want to become technology investors. As a young manager myself, I always try to say, if you're a young person, where should you put your capital? Some of the companies you're in, whether it's cybersecurity, walk through, one of the better areas you think are attractive with lower valuations.
Oh, well, I don't... That's a good one. I would never, go only into sectors because therefore my hunting field is way too small, just Germany and Switzerland, Austria, and some parts of Europe. But in general, we are really agnostic, and I always look for this, innovation that drives something totally new and has the power to set the prices in their respective niche markets, because then you can gain so much profit out of it. And if you lead that innovation or technology, it's very resilient. That's my advice. Yeah.
All right, Jeremy. So I'm so glad that everybody, you're so busy now. Everybody wants meetings with Jeremy Coller and secondaries firm. But the question is this: is this going to continue? And who are the types of people that are investing in secondaries firms? Is it people that may not have a private markets portfolio and they see you as a better way to enter? Is it people that aren't having liquidity? And what do you see? Is it people that want liquid solutions to an illiquid market? Where do you see the secondary market really headed over the next decade?
So when I started, it was a few $1 million, the whole market. Last year, it was a $100 billion market. 2030, our view, it's going to be $500 billion. And we need new funds because we love the material. We've got 10 trillion of private equity out there to buy, and we're only 1.2% turnover at the moment. If you think of the public markets, it's over 99% is secondaries. The secondary markets, we are going to be called private equity in the future, and you're going to be called primary capital.
Wow. I'm going to hold you to that one.
It's true.
Well, you got to stay around long enough to help the next generation of funds. Oh. Okay, we're going to end with a couple rapid fire questions. So obviously we have some serious subject matter experts here. But Milton, I'm going to ask all of you guys the same question. So if you were to come back here next year, 2025, what would be one word that you would use to describe private markets in 2025?
So I'll give you the answer, and I'll tell you why I get there. The floodgates are open. And the reason I say that is there's about 2.9 trillion of assets that don't have liquidity today. And unfortunately, because of the way the construction of the private equity model is, that you've got to create liquidity for your investors. And so whether you hold it 5 years, or the average hold today is 5.8, it got up to 7 years, which was pretty long duration. And that's one of the reasons the secondary funds are attractive today, because people want liquidity, and even the big institutions want liquidity because they're trying to reinvest their capital and they're not getting enough proceeds, and so they're selling off parts of their portfolios. So I think what will happen is there'll be a lot of pressure next year to create liquidity for a bunch of the 2.9 trillion that's out there, and I think you're just going to see lots of companies come to market. Some will have better traction. So for example, where there's limited, so take a company like Osaic that we own, there's 3 competitors of any scale. One's public already, the other 2 are private. There's not a lot of companies you can buy in the space, so therefore the demand will outrun the supply, whereas in the insurance brokerage, where there's 43 platforms and they all want to go public and they all think they're going to get premium valuations, we'll see a degradation, in my view, of pricing.
So liquidity.
Liquidity.
What's your word?
Similar, possibly. I think the secular trends that we invest behind will be strong and will remain strong. I think that if you're looking at the title of this session initially, as you referred to, which was some sort of a gloomy thing, that is less fundraising. And I think that is actually true. That has been done in fundraising 23-24, but overall growth will come. And I think we will see, therefore, the fundraising environment and liquidity, therefore, coming into funds will rebound again in 25.
Growth. Marco?
Even though we are independent as a firm to not raising funds anymore, I believe also that we'll see a lot of deal activity next year. I think it's starting already, because for like almost 2 years, I only saw just a few deals in the market, and highly overpriced. And now prices are coming down. There's more an equilibrium of sellers and buyers, and just see more deals coming to market, which I think is the need for liquidity.
All right, we got a liquidity. So bring it home, Mr. Liquidity.
Liquidity, 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 providing liquidity.
Like they say in real estate, right? Location, location, location. All right, well, thank you, gentlemen. I really appreciate all of you guys on subject matter experts. I encourage you to talk to these gentlemen. They clearly know their areas, and thank you for making the private markets look so attractive. Thank you very much.
Thank you.